everybody, and welcome to the new update, the October update for stable return. We have good news this month. We just reached, we got a new inflow of 20 million euro. So the AUM of the fund now is pretty close to 50 million euro, which was our target for 2021. And we are currently at 48.9 and look to raise fresh money, as also the change of the strategies. The strategy we are gonna talk into this monthly update, I think will provide another boost to our capital raise effort. In terms of, I'm gonna go quickly through the presentation. Let's just a quick update of the strategy and also a quick overview of the strategy for new investor, new clients. They still don't know much about stable return. So first of all, our first point here is our philosophy, which is for us, long-term investment success is not just about compounding capital, so always being on the offense, meaning too much beta, but also capital preservation on the downside. And the problem, I think it's always useful to review this slide every month to see if there have been some changes. For example, we see that cash and money markets still we have a real return negative, and if you go into fixed income long-term duration, as we are seeing this year, there have been let's say negative returns, real returns. They're still, real yields are still negative, so not very attractive for government bonds, especially for European investors. And risk reward then is not attractive neither. The upside is very limited, so you need to trade bonds. You're already buying bonds that are going to be issued over the par, and essentially they're gonna pay at the par after years of after a few years or many years, and so the risk reward is not attractive there. And if you go more into more risky type of assets like investment grade and high yield in the credit space, either in Europe or in US, the spreads now currently are very tight, and so the risk reward is not attractive. In high yield, we can see, or maybe some more in distress rather than high yield, we see some attractiveness, but of course there is more risk. And so if you go into the equity space, public and private, we have still some let's say spots of good risk reward, attractive risk reward, potential positive real returns for the next few years. Of course, valuation are expensive, especially in some part of the markets. And we saw this month Tesla reaching 1.2 trillion. It's not that we have a position there, neither long or short. It's just a recognition that a company that makes between 40 to 50 billion sales and is already 1.2 trillion valuation, pushed just by retail trader trading option finally. And now we're seeing the last few days how the stock went down 15% in 2 days. And so this situation is always the same as at the beginning of the year. Nothing changed. So our approach that we are trying to convey to clients is kind of different here. We want to deliver a new product which is kind of innovative in terms of we don't want to diversify by asset allocation, so putting together credit and government bonds and equity, the classic 60-40, and say that we are diversified because we have, let's say, the credit and the bonds that diversify us. At the end, we saw what happened in March 2020, boomed the 10-year, which used to make double digit during other crises like 2008, 2001, made just 3% because yields were already very, very low. And whilst DAX and European stocks generally, they were down 30, almost 40% at the same time. So we saw spread tight in investment grade. So investment grade lost money there too, and there's been no caution from their rating, the good rating they usually have. So what happens there essentially is that the 60-40 model is kind of not working anymore. We are not saying that there's going to be a quick disruption of this type of allocation. People are still allocating with this type of 60-40 approach, fixed income, credit, and equity. It's also, some of them also there is a mandatory by regulation to add fixed income to the portfolio that is called balanced, although the fixed income can be the risky factor there, and also can be the asset class that when everything is down is going to be down not as much as equity, but it's not going to be any help diversification. It's going to deliver any diversification in a portfolio in a market drawdown. So we have this approach where we use factors to define if a strategy or an asset class is a truly defender. So it means that it goes up when the market is down, and when we say goes up, we mean double digit. Or if it goes up when the market is up and goes down when the market is down, it's more like a striker for us, using the football, European football analogy. So it's more beta proxy. And then we have the real market neutral, which don't depend much on equity volatility or equity upside to make return, but they are much idiosyncratic. And these are the midfielder. This is the classic example of a beta type of beta strategy, a risk-on strategy. This is a risk-off strategy. So the sensitivity, they are all just on the left, on the defensive factors, and this is a pure uncorrelated strategy with as sensitivity just with the alpha factors. And the idea of stable return is to have all these buckets together and to reach a kind of a circle. And as much leverage as we use, we can expand the circle. Of course, we're a UCITS fund. We don't want to run much risk. We also have a volatility constraint. So we're going to use a certain level of leverage. And so our circle, our sensitivity to other factors is going to stay around this type of simulation we provide in this chart. And so if we look at the one we want to achieve, essentially, this is just a pro forma simulation, is compounding capital in the long term, and also preserving it during a period of volatility like 2008, 15, 18. So in terms of the team, these are all our component of the investment team in stable return, and also our operational team of Susan Richard, our CEO, and Patrice Alfonso, our risk manager. And I'm more on the strategy allocation and to capital allocation, and also market risk monitoring. And then we have, as you can see here, experienced portfolio manager, each of them with certain skills and certain asset classes like credit distress, fixed income rates, macro, and special situation equities and commodities. And here you can see the biography. I'm gonna follow with this call with the presentation. And this is the most important part. Let's say how we build the portfolio. Essentially, first of all, we have three objectives. First of all is capital preservation, stable income, and an inflation hedge. We have three building blocks. The first building block is our risk-on bucket. This risk-on bucket now, since we change the fund, and we're going to go through there in a second, now it's become very tactical, dynamic. So we can use 50% of the notional in this bucket, but we can also be zero net exposure. The same happens for the anti-bubble, so what we call defensive strategies, which can be from let's say 0% up to 50% in any certain period. And then we have the uncorrelated alpha strategies, which can be from 50% to 100%. They're the kind of bulk of the fund, the one we deliver, let's say, more the uncorrelated type of behavior of the fund we want to deliver. And the three together, let's say the three components together, three buckets together, is what Quadriga stable return is built upon. So looking into the monthly, we have also an update. So the last month, the stable return was up 0.5%. European investment grade was down 0.8. Year to date, we are still negative 1.7. And this has been caused mainly by our defensive strategies, which have been kind of dragged. We're going to go through it now. And we are still under our long-term target of European inflation plus 5% net of fees since inception in January 2020. So here we can see year to date, the performance now is kind of in line with the Euro investment grade. And here is the contribution by bucket. So risk on bucket, of course, the market has been positive, so it's been contributed positively year to date and also month to date in the last 3 months. Uncorrelated also contributed positively since the start of the year, whilst anti-bubble has been the big detractor this year. So as I was saying, there are important changes in the strategy. I want to assure clients the philosophy stays the same, and the strategy are for, let's say, for the changes are for good reason. So what was the let's say the composition of the strategy the before? First of all, there was a mix of funds. The fund was composed by other funds, external funds, or other internal funds of Quadriga, ETF, futures, and options. The fund had, because of that, low flexibility. So we always had the presence, let's say, of defensive strategies with a certain exposure, fixed exposure. Because the funds, although they were UCITS, they were not, let's say, they're not easy to trade. Let's say it's not that you can add or redeem every week. And so less efficient also risk management due to the lack of look-through into the other funds, in certain funds, especially external funds. And also there was essentially a structural shortage, lack of veto power on the decision of what the other funds wanted to do. Although you're investing in a certain fund, you cannot say them, why don't you sell, or you slow down, or you lower your leverage, for example. And the 4th point, which is also important point, is the cost of the fund were higher because they were embedded the cost also the ETF, which there were some ETF that has just 20 basis point total expense ratio. Other ETF, they had also 60 basis point, and then there were other funds. They had between 1.2% management fee and some performance fees. So all these disappear now. So we are a fund that directly invests into instruments. So let's see, now from mix of funds, ETF, future, and option, we are now investing in single stocks, bonds, futures, swap, and option. So we gain flexibility. So we have now flexibility, and that's why we introduced that the defensive risky buckets can be also 0%. And so if we like a defensive strategy, which is a good entry point for a defensive strategy for a certain option, we invest in it. Otherwise, if the risk reward of the defensive strategy is not good, it's expensive, we don't do it. Very efficient risk management now through the breakdown of the entire portfolio by instrument and bucket. So now we can have the risk line by line, and we know our risk pretty well, what we're running in terms of risk and also in terms of stress test. What we can do now, essentially, better than before. It's not just sometimes the bit of power. If we don't like a strategy because it's not working, we can get rid of it in a very quick time. And also, what we can do, we can also see position by position and stress test all our underlines and the portfolio overall, which we couldn't do as well as we are doing now earlier, because funds, of course, where you used to have funds with, first of all, had some lack of historical track record. So we had replicated the funds track record using factors. And sometimes, of course, these stress tests were not very efficient. And of course, last but not least, the fund now is very less expensive because there are not anymore ETF or external funds. So the fund now, it's the total expense ratio of the fund decrease in a sensible manner. So the good point here is also that we added more expertise to our team through the merger of our team with the raw team and Christian Tum, which is our equity expert. So we are all working together on the fund, and we have much experience all together. We have many years of experience, and I think the fund is also so. We are capable of deploying the strategy we want to deploy. We have good track record in that, and also the fund is less expensive because we don't use external funds as previously to deploy our macro view. So, first of all, I want to choose the raw team, which is a team of 5 to 6 traders. You can see there the Jose Mosquera, which is the CIO, which many experience in credit in top banks in Europe. Rodrigo Hernando, which was the CEO and one of the partners of Quadriga. And this is their track record. It's an hedge fund with weekly liquidity. It's not the UCITS, and they've been managing the strategy since 2007. And this is the track record. Has been 7.5% net annualized, 10% volatility. Just since inception, just one period has been a tough period, which has been 18 plus 19, where some of the strategy didn't work. And let's say this has been just 2 years out of 12 years of managing money where they had some tough time. 2020, they had the initial drawdown in March, but then they recovered pretty well. And in 2020, they ended up the year with 18% positive performance, whilst this year, 2021, they are currently 15% positive performance year to date, everything net of fees. On the macro side, raw team, which are going to be the main traders of the stable return, alongside raw team, we are gonna, let's say, we're gonna have a macro outlook, a macro investment committee led by Diego Parrilla, Alfonso Torres, Christian Tum, and also attended by Jose Mosquera and Rodrigo Hernando. And then we have always our robust risk management we built in-house with me as a final strategy allocator and bucket allocator according to risk parameter, which are all systematic, and David Serrero is our quant analyst. So altogether, we are working in a stable return, quality return, which is going to be more tactical strategy, more opportunistic, seeking positive alpha across all asset classes. So thanks also to our team, we are going to add very serious expertise in credit and distress and bonds generally. And the volatility is going to stay moderate. Of course, this is the track record I show of ROI is 10% volatility in the hedge fund, which is a bit more volatile. Stable return is going to be on the low range of volatility. It's going to stay always between 5 to 6% volatility. So that's why we want to sell the strategy as a fixed income replacement. Currently, we are building the positioning with the raw team, and the strategy is mostly in cash now, with some we can see on the chart, on the pie chart on the right, with zero on risk on, zero on risk of, and just some position in uncorrelated. And in terms of within the uncorrelated, we have some relative value. We have short-term option, essentially, some relative value in equities and FX and bonds. And in terms of quick macro, still the same as last month. We see increase in valuation. I took instead of the CAPE CV adjusted P, I used the Tobin Q, which at the last quarter data provides to be the highest number since they started to track this indicator. And the impressive thing is now higher than 2000, the dot-com bubble. And it's interesting also to see compared to the personal saving in US, which increased a lot during COVID, and this spike we saw during COVID is also been the push, big push we had from retail investor into equities, and also pushed the stock valuation. But now the savings are kind of back to normality. Still high compared to the last 5-10 years, but not anymore as high as of course during COVID. So unless there's going to be no other, let's say, check from US government, I think now the market is going to be more volatile coming forward. The multiple has been the multiple expansion has been huge. Many companies they've been provided amazing earnings, also good surprises, but many of them have been pushed by also consumers, the pretty strong consumer spending, especially during COVID time, during all 2020. Now economy is gonna slowly getting back to normal. And I think we're going to see more volatility on the quarterly earnings and on the stock market overall. They're going to be the retail investor. They're going to have less power, let's say, drop powder to push stock market higher through option, although they keep doing it. But they're going to be more sensitive if stocks are not going to perform well in, let's say, an earning call, or they're gonna be quick to switch and to let the stocks drop a lot. And we saw this week with AMC, which retail investor, they were betting on a big surprise, but then there was not any big surprise. Actually, it was a pretty pessimistic call by the CEO, saying that of course the theater sector is not still out of the wood. There is still COVID lingering around, and the stock fell to 12% the following day. So said that, spreads, as equities are all-time high, spreads are still keep being all-time low, either for high yield and investment grade. And the curve that was, let's say, steep, went pretty steep during September. In October, as at the first part of October, the steepness went higher, but then it decreased a lot in the last couple of weeks. So let's see what's going on there. Usually flattening in the curve has been followed by some stock market volatility after a few months. So let's see. And on the other side, we always check the inflation expectation using the five-year inflation expectation, and they're still in line. They didn't increase much during the last couple of months. They're still, let's say, in line on the last 5 or 6 year inflation expectation, although they are at the, let's say, pretty high range. So another thing we always monitor is if inflation expectation goes under, let's say, out of control. They can push central banks to tight quicker than expected, and then can cause, of course, pain to the stock market. So just to finish, we still have the free share classes available. Of course, the Cedar share class is for pretty big amounts, but we always open for discussion. And pricing and liquidity are daily. Now the fund AUM is 48.9, and the country registration, as you may see now, we're also in Italy. We just reduced in Italy and Germany. So happy to discuss one-to-one to talk a bit more about the strategy, or to have also a conversation with Jose Mosquera or Rodrigo Hernando, which are the key people within RAW and the key people now in stable return. Thank you, and we're going to have an update next month.